Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. Thank you for joining us for our Latham and Watkins Asia Insights Restructuring Talks podcast. I am Howard Lam, Restructuring and Special Situations Partner in Latham's Hong Kong office. In this episode, we are talking about China bond defaults. And with me here is Kenneth Ho, Managing Director and Head of Asia Credit Strategy Research at Goldman Sachs. Ken, thank you for joining me.
Yes, thanks, Howard, for having me.
Well, let's get started. So what is the story for Asian credit so far in 2020? Have you seen a sharp increase in defaults by Asian bond issuers and non-performing loans on banks' balance sheets?
Well, if you look at the year as a whole, defaults have been relatively well contained. So for Asia high yield, the corporate default rate we estimate is 4.2% so far this year, which is not too dissimilar to the level we saw in 2018, and is roughly half of what we're seeing in terms of US high yield default rate. In terms of onshore bond defaults in China, we estimate there's been 23 new defaults so far, compared with close to 40 new defaults in each of 2018 and 19. And then if you look at China NPLs, it's been around 1.9% this year, relatively stable. So if you look at it in aggregate, things look relatively benign. However, if you look at what's been happening more recently, the picture is changing. Now, earlier in the year, we saw China policymakers in a much more forbearance stance with a lot of debt rollovers. But recently, policymakers seem to have shifted back towards more of a credit cleanup stance. So as a result, we've seen the pace of domestic bond defaults having picked up quite noticeably. So even though the overall picture doesn't look that high, things are definitely changing.
Thanks, Ken. What do you think are the likely causes of these defaults? And is support from government still available?
So again, it's interesting to see how things have developed this year. Because if you look at many of the China defaults earlier in 2020, we think most of them, if not all of them, relate to borrowers that had issues back in 2019. So many of the earlier defaults really were not related to COVID, but for issuers that had problems that were already apparent in 2019. Now, the picture has shifted in recent weeks, and in particular, given the increase in onshore bond defaults, we've noted that many of them are for state-owned enterprises, for these SOEs. So clearly, we think this indicates a shifting of policy stance from policymakers in China, and we think this means some of the implicit government support have weakened. However, we don't think that this implicit government support has been completely removed. We think policymakers are operating with two objectives at the same time. So one is, as we mentioned, credit cleanup. The second is the prevention of systemic risk from emerging. And so we think those two will go hand in hand, and which is why we think any removal of implicit government support will be gradual and certainly is not being completely removed.
Given China's significance in any Asian credit strategy, how do the China onshore market compare to the dollar bond market? And what do you think is the volume of bonds trading at a distress level at the moment?
Now, it's difficult to know how much of the onshore bond market are trading at stress levels, but we do think that there are a couple of things that's worth noticing. First is that if you look at the onshore bond defaults this year, quite a few of them have been for larger companies. So we are seeing a trend of larger defaults occurring in the onshore market. Now, second, if you look at the US dollar high yield market, we estimate somewhere around 8 to 9% of Asia high yield are trading at a price below 80 cents on the dollar. So this does indicate that there's quite a bit of high yield corporate bonds which are priced at stress levels. Now, the one big change that we see now versus 4 or 5 years ago is that many of the Chinese high yield bond issuers now have both dollar and RMB bonds outstanding. And so it's also quite possible that for the next China bond default, these companies will have both RMB and dollar bond obligations outstanding. So this could make the restructuring a little bit more complicated. And obviously, we will need to see how different sets of bondholders are being treated and the recovery prospects. So there's definitely something to look out for.
Well, correct me if I'm wrong, but I think China has the second largest bond market in the world. And most of the Chinese corporate bonds are issued in RMB, the domestic currency, and are traded on either the Shanghai or Shenzhen exchange. Let's talk about the domestic bond default first before we move on to the dollar bond markets. There's been a marked increase in domestic bond defaults in the past year or so, and there are numerous reports of issuers getting away with inadequate disclosure, persistent repayment delays, and protracted bankruptcy proceedings. And what are your observations on the China bond market this year?
I mean, certainly the developments have been relatively slow in the sense that so towards the end of last year, we put out a report looking at many of the defaults. We actually estimated around 100 defaults that had occurred in the domestic market in China. And towards the end of last year, only half of them, or roughly half of them, were unresolved. And only a small proportion were actually resolved mainly through bankruptcy restructuring. And so it's quite clear to us that there's still a lot of work needed in terms of figuring out how some of these restructurings could take place. Also, what we've noted this year is we've seen situations where a company has dollar bonds and RMB bonds outstanding, but in certain situations, for example, there's been bilateral negotiations with some of these onshore bondholders and some bilateral deals taking place. For example, some bond obligations being exchanged for property, for example, that we've seen. So what we think this shows is that there's still a lot of work needed in terms of getting more clarity on what the restructuring process looks like, which reiterates the point I was making earlier. You know, when you have dollar bonds, RMB bonds, different set of bondholders, and they default, the process certainly could be quite complicated.
It seems that you and I could agree that post-default workout is protracted and the path to resolution is often not very clear, leaving many defaulted issuers in limbo. Chinese regulators have rolled out guidelines to improve the handling of bond defaults at the end of last year. The central bank, PBOC, the Economic Planning Agency, NDRC, and the securities regulator, CSRC, jointly published rules last December for handling bond defaults, and stressing the importance of creditors' meetings and urged custodian banks, underwriters, rating agencies to take more responsibility in resolving defaults. Regulators have also more recently issued guidelines on trading defaulted bonds and the mechanism for carrying out an exchange offer. So courts are scrutinizing bond underwriters' behavior. What sort of recovery rates do you see from the China bond markets?
I think we both agree it depends, right, in terms of the right answer, because every situation is different. But for example, if we look at some of the defaults that's occurred this year in the dollar market and how they've been dealt with, we've seen distressed buybacks, distressed exchanges, and of course we've seen missing payments, and the process under those can be protracted. And so it really does vary. It's possible to see a distressed exchange with a relatively high recovery rate, but at the same time, it's also possible to see missed payments and the situation gets dragged out over a relatively longer period of time. And so you have a relatively wide range of possibilities. Now, what we do think is pretty interesting is at the end of last year, we've seen a couple of SOE defaulting, and we ended up having distress exchange at a discount to par. So what we think this indicates is that there is some government support in there, but this government support may not give you par recovery. It may give you a recovery because some of these types of distress exchanges are supported by government entities, but you may still need to take some haircut on your recovery. So all of these things we think are factors that investors need to think about, and there's no real kind of clear or fast rule of thumb really in terms of putting a number on the type of recovery.
Thank you. Moving on to the dollar bond market, and in particular, the credit support that's available. Now, let me perhaps briefly introduce the typical legal structure used by Chinese companies to issue bonds and the implications in the default. When Chinese companies are issuing US dollar bonds, typically it would involve an offshore financing vehicle that issues the bonds, with the subsidiaries owning the operating assets located on mainland China. The issuer vehicle is usually incorporated in Hong Kong, Singapore, or a convenient offshore jurisdiction, such as the Cayman Islands, and might have its shares listed in Hong Kong, Singapore, or elsewhere in order to also access the capital markets. In recent years, we're starting to also see PRC incorporated companies issuing bonds directly into the international markets. In other bond markets, subsidiaries of the issuer will often guarantee the bonds, giving bondholders a direct claim against the subsidiaries with the revenue and assets at the same level in the corporate structure as the other debts of the group. This is difficult to do for Chinese bonds because PRC foreign exchange controls limits the ability of onshore subsidiaries to guarantee offshore debt. Any subsidiary guarantors tends to be offshore intermediate holding companies with little revenue or assets of their own. Whilst China's foreign exchange restrictions are relaxing, most of the China dollar bonds still do not have credit support from the onshore subsidiaries. The onshore subsidiaries would typically have significant liabilities of its own owing to Chinese banks and other local creditors. Structural subordination to onshore debt is a real concern. Some of the bonds we have seen in default situations are issued with the support of so-called keep wells. These are not guarantees, but an undertaking from keep well provider, typically the onshore parent company, that it will procure that the issuer will maintain a certain liquidity position and to make available to the issuer sufficient funds to repay outstanding bonds. These types of structure are being tested in defaults for the first time in recent cases such as CFC China Energy and Peking University founder. It has been reported that the Shanghai court has just recognized a Hong Kong court ruling validating the keep well structure, whilst the bondholder of the Peking University founder group are still struggling to have their claims recognized by the PRC bankruptcy administrator. How should investor look at these types of credit enhancement?
So for keep well structures, we are of the view that they do provide support. And there's two reasons for that. One is reputational. So we do think issuers need to stand by the keep well deals in order to protect their reputation rather than to step away from them. And secondly is the threat of litigation. So even though there may not be a guarantee from the parent company or one of the operating companies, there is a threat of litigation if you do default on keep well agreements. So for these reasons, we do believe that they have value in terms of offering support. Obviously, the unknown is how strong is that support? And we are of the view that for issuer, if you have bonds that are guaranteed by, let's say, a parent company in China or an operating company in China versus the same issuer issuing bonds in the offshore market using a keep well structure, we feel that the probability of default is the same for both structures. So the difference is really mainly, in our view, going to be in your recovery prospects. And so the question is, well, how do you price that recovery prospects? We're of the view that obviously, if you're a strong credit with a very, very low or minimal risk of default, then clearly there's less of an issue with regards to a keep well structure because your probability of default is very low. But obviously, as you move down the credit spectrum, the riskier you are, then these structural differences gets magnified. So we came up with a very simple rule of thumb. And this is estimating, let's say, if you have a senior unsecured bond deal guaranteed by the company in China, let's say your recoveries are 40 cents. And then let's hypothetically say your recovery on a keep well was at 20 cents. Then, we made some estimation and we came up with a rule of thumb, which is for every 1% assumption in default probability over a year, you add 20 basis points in terms of a keep well versus a non-keep well bond. So as you can see, if the probability of default is minimal, the pricing differential we think should be minimal. But let's say you think for an entity, there's a 10% probability of default over 1 year, then we would say then maybe you should think about adding 200 basis points in terms of a keep well structure versus a non-keep well structure. So we do think they offer value, but obviously, where that value resides is still a bit of unknown. So hopefully some of these cases will give us a little bit more clarity.
That's very interesting. Thank you, Ken. We at Latham has advised on a number of distressed bond exchanges, consensus stations, and bankruptcies in relation to defaulted Chinese bonds. We do see a huge variety of legal structures, bond indentures, trust deeds, jurisdictions involved in any particular case. This is probably the first credit cycle in which Chinese dollar bonds are tested in distressed situations. And these bonds are often governed by a variety of governing laws, English law, New York law, Hong Kong law, and multiple jurisdictions would be involved in any restructuring. So we think bondholders and issuers would be well advised to pick the most favorable forum in these situations, whether for taking enforcement action, filing for bankruptcy protection, or to implement a restructuring through, for example, schemes of arrangements, exchange offers, or even a US Chapter 11 plan. All these tools have been used for resolving China bond defaults recently, and their effectiveness, I think, is yet to be tested. And now looking forward, how do you see the pipeline in 2021? Will there be more defaults? What should investors do to find values?
So we think it's worth looking back and taking a step back. If you look at 2007, 2008, right at the onset of the global financial crisis, and then from then until 2016, China embarked on a very large credit boom. So in terms of non-financial debt to GDP, we estimate that it rose from around 150% to 260. However, that credit boom ended around 2016. So from 2016 until earlier this year, it's been relatively stable. So clearly, policymakers have shifted towards cleaning up some of the credit excesses. Now, 2020, China's going to lever up again, given the impact of COVID and the need for government spending, which is really no different to any other countries around the world. But for 2021, we expect China to go back to the credit cleanup mode, especially now we are seeing China's GDP back to pre-COVID levels. So we expect for next year, China's leverage to go back to this stability path. So what this means for default is we think it will continue to emerge. So for the domestic corporate bond market in 2018-19, we saw roughly 3 to 4 new defaults a month. And we think we could get back to that kind of level. In terms of the dollar high yield market, we're forecasting 4.3% China high yield corporate default rate for next year, which is slightly lower than this year, given that we've had a few large dollar bond defaults already in 2020, but it also shows that defaults will continue to emerge. So all in all, in terms of what we're expecting for next year, we are certainly expecting policymakers to continue on a credit cleanup mode. We are expecting defaults news to continue to hit the headlines. And we're also expecting, from a market's perspective, further credit differentiation. So those, we think, are the key themes for next year.
Thank you, Ken, for joining us today.
Yes, thanks, Howard, for having me.
Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcast on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things, and you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.